Hello and welcome to another episode of the Investor Financing Podcast. And I'm your host, Beau. And today we're going to bring some more value to you. And we're going to be talking about something I don't have a lot of knowledge on how it works. So I'm going to ask some good questions, hopefully, that come up top of mind on this. But please welcome Brett Swarts. Brett is a Deferred Sales Trust trustee, DST expert, capital gains tax deferral expert, investment real estate expert, multifamily broker, and the founder of Capital Gains Tax Solutions. Welcome to the show, and thanks for joining us.
Beau, pleasure to be here. Thanks for having me.
So I just want to kind of get into this. So instead of a 1031 exchange, right? Like now everybody talks about what your options, like you have an investment property, you've depreciated it, and now you either got to sell it, you got to 1031 exchange it. And now we're going to be talking about DST sale, a deferred sales trust. And we're going to talk about the mechanisms of how this works, which is above my pay grade, but I'm going to ask a lot of questions that I think are relevant. Can you give us kind of like, well, welcome to the show, first of all.
Good to be here, Beau. Thanks for having me. Yeah.
And you can tell I'm excited to like dive into these questions, but yeah. Could you just talk to us about the DST and how you fell into this and how you learned about it, and now you're helping people keep their wealth, essentially.
Yeah. So most millionaires, they struggle with capital gains tax when they go to sell their highly appreciated cryptocurrency, business, real estate, YouTube channel, whatever they're selling. They have a huge capital gains tax. Well, we use a deferred sales trust to give them tax deferral, liquidity, diversification, and the ability to buy back into assets at any time, all tax deferred, so they can create and preserve more wealth. And so the premise is none of us really like to pay tax. And the idea is, how do we use what the IRS has laid out to us in their 10,000 page tax document to exit smart, right? And so it works for cryptocurrency, business, real estate, primary homes. You can save a failed 1031 exchange. It's an alternative to a 1031 exchange. Most people just don't know how to do this, or they think they've heard of it. This is not a Delaware statutory trust. This is not a TIC. This is completely separate, and it allows you to defer tax and create wealth. And so that's the first part, Beau. Any questions there?
Well, yeah, I have questions, but we can kind of get into it in a little bit later. I guess what I want to know is how'd you learn this, and how did you get involved? I see in your bio, you're a very experienced investor as well as multifamily broker. So right. I'm guessing your years of real estate experience, you found this hidden gem here.
Yeah, what's my journey to the Deferred Sales Trust? Well, it started out in 2006. I was at Marcus & Millichap as a real estate broker, and I'm helping people buy and sell multifamily properties. I'm learning about 1031 exchanges, and things are going really good. I mean, the marketplace is all-time high. Things are great. And then something happened in 2008. The market kind of just fell off a cliff, and we hit the kind of a brick wall. And then I saw friends, family, and clients lose half. Some lost everything, and part of what we could identify was they had too much debt, not enough liquidity, and they had overpaid via the 1031 exchange. During this time, I'm still new to the business. I'm still just getting everything going. My wife and I are at home, and we're struggling to keep food on the table. I do what every good entrepreneur, real estate wannabe does. You get a side hustle. So I'm working at Cheesecake Factory by nights and weekends, and by day, I'd be negotiating with banks, helping clients keep their properties, help them to reposition their properties, and essentially identify what went wrong. And we found out that the 1031 is not your friend a lot of times when the marketplace is a seller's market, when you're not finding a deal. And that's when we learned about the Deferred Sales Trust. So this began this journey of studying this and understanding it. And I started to apply it to my business. And so fast forward, I was able to really grow my business, educate people on how to do this. And my business, I was able to retire from the Cheesecake Factory, and my wife was able to stay home full time with our 5 kids now. And back then we just had one. And I'm here in Sacramento, and now we just coach and train people how to do this. CPAs, financial advisors, commercial brokers, luxury realtors, crypto experts. And that's our passion.
Awesome. That's awesome. So let's just have a hypothetical case study. I own a 100-unit apartment building, and it's ran its course for me. It's appreciated. I depreciated it. Now I'm like, okay, I want to retire or whatever I want. And my options are to sell it and pay tax, or possibly look at doing a 1031 exchange. But the market's a seller's market, and I'm not going to be able to replace it for, I'm going to not find any good replacement properties at this time. So then I call Brett, and I tell Brett my scenario, and Brett's going to give me this option. And could you kind of just walk me through the mechanics of, I guess, the proceeds from the sale go into a trust, and when, or actually what I'm thinking is I'm actually confused. So will you kind of walk me through how it works, and what are the benefits? I understand the benefits of not having to find a replacement property or pay tax, but I just need to know the mechanics. And sure. I think people watching this now,
I'll make it super simple, Beau. Like, it's called a kind of like bridge, right? And so Russell Brunson says it well, like when something's complex, let's try to make it super simple. So the deferred sales trust is kind of like an IRA. So think about this, Beau, or a 401k. You can put money in there, tax deferred, and you don't pay tax until you receive it out. So I want you to think about exiting. Let's just say your property's worth $200,000 a unit, and it's 100 units. It's worth $20 million, okay? And you're looking at a zero basis, and you're like, oh my gosh, like I'm going to pay huge tax on this, and I don't want to pay the tax. Can I put it into this kind of like IRA thing where I can just keep it deferred? And the answer is yes. So at close of escrow, the funds go to this deferred sales trust. Once they're there, the buyer's already got his property. He's closed. He's good to go. The funds are sitting there and they're growing based upon the interest that the investments are made. And it could be stocks, bonds, mutual funds. It doesn't have to be like kind. It doesn't have to, because it's not a 1031 exchange. It doesn't have to be a 45-day, shotgun wedding, 45-day engagement, 180-day shotgun wedding. It doesn't have to be all this pressure to overpay for property. And you might even want to retire. I mean, a lot of our clients are just like, hey, I'm done with the $20 million deal, right? I've had it for 30 years. I just had a deal in Arizona for $2.25 million. His name's Chuck. And he's like, Brett, I've been doing this for 25 years. It's student housing in Tucson, Arizona. He's like, it's 60s construction. It's just flat roofs. It's got all these things. I get random calls from all these students all the time. He goes, I've worked for it. I've got a couple $1,000,000. I don't need this anymore in my life. Like, let me just retire. Let's just put it into conservative stock market stuff. And let's just get a consistent income, and I'll pay tax slowly along the way. I have other clients that are very entrepreneurial. They're like, Brett, I want to exit my business, but I want to go start another business. I'm not ready to be, sleepy on this thing. I want to be active. And so they can partner with the trust and they can build. And so one client in Alabama sold a $2.6 million business, and he's building 70 multifamily units in Tennessee, all tax deferred. The trust is funding a part of that project, which is pretty cool. I got another client. She just sold cryptocurrency. She bought it at $50,000 and went to $50 million. She goes, Brett, I never exited until I met you. And part of why is A, I didn't really have a good tax deferral strategy, but B, I didn't know I could partner with it and buy a business with this. And so she started a business all tax deferred with the trust. And so these are all the things that we're educating people on how to do. So does that answer the question so far, Beau?
Yeah, no, this is really, really interesting. This is cool. So let's just say I bought into a franchise and I have 10 units and I want to sell that. I mean, it could be business too. So, which is great. So the proceeds go into this trust. And it's just kind of like a self-directed IRA in a way where I can pick the vehicles that I want to invest in. It could be additional real estate, and it could be stocks, bonds, gold, silver, or whatever. Is that accurate?
Yeah, it could be insurance products. It could be hard money lending. It could be passive or active real estate. It could be the stock market. It essentially works just for about anything that you want to invest in, as long as your risk tolerance, which you fill out in the very beginning, and the investments are basically correlated. Like, we don't want to put a very low risk tolerance and go put in some very speculative stuff, right? Or we want to make sure we have enough liquidity for your needs to pay you out. So these are things that we're balancing out. Like if someone has a financial advisor, as long as they're not a related party, we work with financial advisors all the time, and they might be a part of the whole discussion, or their CPA. And so it's not like a one size fits all, although we do know we can defer the tax. The question is, how do you want to receive it back? Where do you want to invest it? And for some people, it's different. Some people, it's mostly real estate. Some people, it's like no more real estate ever again. Some people, it's no more active real estate ever again. Some people, it's a mixture of cryptocurrency, real estate, and businesses. It just depends. And that's part of where we like to help people, guide them along the way to make good decisions. But some people are they know how to make the money. They just need the tax deferral part, and they're just like, I'm going to go make the money. I've got deals, I've got partners, I've got opportunities. How do I stay within the guidelines without having to get taxed? And that's how we walk them every step of the way through.
So I have a buddy, and he's selling a company. He had, I guess what you call phantom shares. So it's going to be taxed as ordinary income because they're phantom. So he's going to get a lump sum of several $1,000,000. So would that scenario possibly fit this?
It all depends on the timing of the sale. It depends on the structure of the deal. Depends on a number of things, but generally speaking, absolutely. It works for public, private stock. It works for shares. It works for LLCs, S corps, C corps. As long as we set it up prior to him receiving what's called constructive or actual receipt. So what does that mean? Well, if the thing's closing tomorrow, the deal's basically done, and they haven't set up the trust, you can't throw it in the last minute. The funds are going to be sent. But if you're like, Brett, it's a couple weeks away, it's a couple months away, like it's not finalized yet, there's still some things, then we would just sit down with your friend and with the tax team. We'd take like an x-ray of the deal. It's like, show us how you own it, show us the documents, right? Let's review it, all confidential, right? Let's ask that other group that you're working with, hey, I would like to exit on this kind of like an IRA thing. I want you to send it over to this trust, and can we insert some legal language in the actual trust into the closing? And yeah, I mean, it didn't change what they do, and they say, yeah, no problem, right? As long as they say yes, we're good to go. We put it in there. The funds go to the trust instead of going to him directly. It's when he's in a tax deferral state, and away we go. So yeah, I'd love to talk with them if you're open to making the introduction.
Sure. Yeah. This is why I do this podcast, because not only am I listening and learning, I hope everybody that's watching and listening gets to learn about this, because this is what's great about YouTube University, that we get to bring cool guests on and we learn from. And hopefully if something comes your way and you need to defer a big chunk of money, you have some options, and that's the conversation today. So then there's the funds are held in trust. There's a trustee. The trustee acts as the custodian, essentially. You give written instructions to the custodian, the trustee rather, that, I'd like to invest into these assets, and that's how it works. And there's always that third-party trustee involved. Is that
very
accurate?
close? First of all, that's people are probably wondering, who am I? I'm the third-party unrelated trustee. Very important, unrelated trustee, right? So if it was a related party, it'd be taxable. So like if it was Beau's deal, not Beau's brother or cousin or best man in his wedding or former employee, something that could be construed as too close for what's called arm's length when it's separated, because I have to be in it for what's called business purpose. There's all these things, guidelines we have to follow. But yeah, I'm like a custodian. I'm the trustee. Remember what's happening here, Beau. You're actually lending the funds to the trust. So if it was your $20 million deal, you're becoming the lender. You're not the owner of the trust, because if you were the owner, it'd be taxable. Right? Just like you're not the owner of a 1031 qualified intermediary or even the owner of an IRA company, right? So there's these different things that separate you basically from paying the tax and separate you from what's called unilateral control. However, you are correct in that you must approve all investments in writing. Nothing moves without your approval. Now, they also don't move without my approval, because I'm the trustee. Because if you had unilateral control, it'd be taxable. So we're working as a team here, right? Now I'm a friendly trustee, and I'm going to review the investments. I'm going to review your risk tolerance questionnaire, and we're going to review this together. And the financial advisor is also separate from me. And collectively, it's like by committee, although you're like the CEO, I'm like the COO, and the financial advisor is like the CFO. And collectively, we're saying, how do we get this $20 million back to Beau, plus an 8% return, given the risk tolerance that he's filled out and based upon his needs and his goals. And we're working this thing out as a team. Does that make sense, Beau?
Yes, that makes sense. So as the third party, what checks and balances, like, are you like insured? How does that all work? Like the whole process. I know, like, if you're dealing with a self-directed IRA company, I mean, I guess there's these entities that are there, they're insured. Like I just don't know the mechanics yet.
Yep.
So
How do we
that's
know the
why I'm
funds
like,
protect it? They're not, the trustee's not running off to Mexico with Beau's $20 million, right? Like, first of all, we work with some of the biggest banks in the world, Charles Schwab, TD Ameritrade, and financial advisors that are securities professionals, right? That's where the funds go. Okay. That's the place. We also work with a big $16 billion bank out of Southern California for our entrepreneur real estate clients. This is a commercial real estate bank. It's protected and secure, all that stuff. You get 24/7 access to view the funds online. The funds don't move without your approval. So we have all of those in place. Just like if you were to sell and just pay your tax and go to these same places, the funds don't move without your approval. Same thing here. Now, it's dual approval, which we think creates even an extra layer of protection there. And the banks will call and make sure certain wires over certain amounts are approved, and all these little checks and balances. So that's what keeps the funds safe and protected. And so I think that answers your question. Any other questions there?
no, that's good. Now, since this is probably not well known with tax advisors and so forth, like you probably have to do a lot of educating, I'm guessing. Like I'm asking these questions because I don't know. Is there case law, or have these ever been like, how long's this kind of system been around? Has there been any case law from the IRS trying to penetrate it and that kind of thing?
Yeah. How do we know that the deferred sales trust is legal, which is one of the most important questions to ask? The answer is 25-year track record, thousands of closes, billions under management, and over a dozen no-change IRS audits. I'm talking not even a single change to any of the audits. The biggest deal was a $125 million deal in San Diego. Now, there's been an extra 3 formal audits, so also no additional changes. National law firms have reviewed it. Huge, billionaires have used it. Doctors, dentists, orthodontists, cryptocurrency millionaires, real estate owners, on and on. It keeps going, and it literally has a perfect track record, but it's proprietary and it's protected, and most people just don't know how to do it, or their advisors have never heard of it, or they get it confused with the Delaware Statutory Trust. So it's still this learning curve for how and why it's legal. Also, there's a lifetime audit defense in case state or federal it is challenged. And again, the track record is perfect. So that's the legal track record. But I like to tell this story to help people, even because it's one thing for me to say it or even Beau to say it. We're humble, commercial real estate, multifamily broker background. I'm not a CPA nor a tax attorney. And so I hold a little bit of clout. Maybe Beau has a little bit more than me, right? But I want to tell you a story of a gentleman who holds even, I think a higher level of credibility. His name is David Young. And I don't know if you've heard of a guy named Bill Gross, Beau, but Bill Gross is kind of like a Mark Cuban, if you will, of the financial advising industry. Very respected, very well known, and he's been doing it for like 30 years. Okay. And so Bill and David built a company called PIMCO from 80 billion to 1.2 trillion about 20 years ago. And PIMCO, again, manages money for some of the biggest wealth in the world. Okay. And these guys, you can imagine, get approached with stuff all the time. Hey, sell my tax thing. Hey, let me tell you this stuff to your clients. Hey, I got this thing you've never heard of. It's so great. You're going to love us for it. And they're like, no. They're always just saying no. Okay. Most of the time. Now, Bill and David, they all retire with another 4 guys about 15 years ago. And then David forms a group called Anfield Capital out of Southern California. And then 4 years ago, David and his team are approached with the Deferred Sales Trust. And they're cautious, but they're optimistic that it could be really, really neat. And so they don't do a 2-day or a 2-week or 2-month due diligence. They do a 2-year due diligence. Okay. And they have their legal team look at it. And they talk with the clients, they talk with the banks, they fly back, they meet with my business partner who's the tax attorney who created this, and they whiteboard everything out, and they spend 2 days straight going through all the stuff. After 2 years of due diligence, they come to 2 conclusions, Beau. Here's number one. Number one, that's the smartest person we've ever met, which is saying a lot. Number 2, we are all in. We will become a part of the DST inner circle. We will offer this to our clients. We will also offer to any deferred sales trust client out there who wants us to help manage the money with the financial advisor. We will support that. And so I always ask this question, Beau, if it's good enough for David Young, who built PIMCO with Bill Gross from 80 billion to 1.2 trillion, 30 years in the business, putting his team of due diligence for 2 years on this, reviewing it all, and he's putting his name on it. Is it good enough for Brett, Beau, and all the other folks that might be skeptical about who they're listening to this right now. And honestly, once they watch the YouTube video of me interviewing David and him telling the story, and they talk to us about this, I'd say 9.999% or 99.99%, they all say, yeah, it works. It's great. But the biggest thing is people have their trusted advisors that have taken them from 0 to 1 million, 1 million to 10 to even 100 million. And they had these trusted advisors for 25 years. And so to shift from what their advisors might say is possible or real to someone who's saying this is real and possible is hard. Now, this is my encouragement for those who are ultra high net worth. Don't bring the CPA or the tax person in the rearview mirror. Don't have them chasing you in a car behind you. Have them right in this passenger seat as you go through this journey with us. We literally take off all the pressure. There's no cost for the due diligence. Talk with our tax team, literally form the trust, do everything in order, ready to go. If you don't want to do it or your deal doesn't close, you don't owe us anything. We do all the work prior to, and then we only get paid if it executes. But some people hear this and they're just like, oh, my CPA would have known about it, or he would have told me, because they're the smartest. And well, guess what? There's 10,000 pages in the tax law, and they might be experts in the first 100 pages, but 5,600 pages into the tax law, there's another page. And by the way, people might be wondering what's the page. It's IRC 453. It's an installment sale. It's known as a seller carryback, but it's not. That's the foundation of the structure. But the way we apply the structure in the law is the secret sauce, and that's. So I'm going to pause there. Make sure that makes sense, Beau.
Yes, that makes sense. That makes sense completely. I got it.
Cool. Awesome. What other questions do you have?
Let's talk about multifamily again.
Okay.
I am a limited partner in a syndication. They're planning on doing a 1031 exchange. I introduced the syndicator to yourself. And instead of doing a 1031 exchange, will this work on a limited partners? Could they? Well, they're not exchanging into a DST, but would that process potentially work on a syndicated deal?
It does. The Deferred Sales Trust work for commercial real estate syndication, of which I am an LP in? The answer is yes. However, it's important to understand that our minimum size deal is $1 million net proceeds, $1 million gain. Unless you have two LP positions or a crypto deal and a business deal, or LP and a GP of 500 each, and then you can combine them into one. Let me give you a deal story. In Vegas, a client of mine, they sold a $20 million apartment complex. Okay, his gentleman's name is David Sloan. You can actually watch the YouTube podcast interview. I interview him, and he tells this story. Now, he and his partner Jordan had huge GP interest, and the rest of the LPs had smaller interest. So they, instead of doing a 1031, which they never do anyways because it's so complex with all of those parties, right, they exited into their GP positions into the Deferred Sales Trust. Now, had they had LP positions, they can do the same thing. The key was, though, a lot of their LPs were 50 to 100,000 to 250 to 75,000. So those were too small. But for larger amounts, the answer is yes. Does that make sense, Beau?
Yes, I got it. Okay, this is fascinating. So just going back to the mechanism, I sell my $20 million apartment. It goes into the Deferred Sales Trust. It's essentially, I'm basically, the mechanics from there is I get a loan. I'm basically getting a loan for that. You are the lender lending to the trust. So you became the banker. So you went from ownership hat to a lender hat. You loaned the 20 million to the trust, 100% finance the trust. This is how it works. And you're getting the 20 million back plus typically an 8% compounding rate of return net of the fees. And you slowly pay tax along the way. As you receive interest payments, you'll pay ordinary income tax. If you dip into principal, you'll pay capital gains tax. But in the meantime, the funds can go into your next real estate deal, your next LP position, can go into cryptocurrency, real estate, stocks, bonds, mutual funds, all these different things to secure the 20 million plus the return, right? And that's the cool part. We're using money that we would have paid to the government to go build more wealth, which is good for them too, by the way. You're probably wondering, well, why does the government allow this? Well, the same reason they allow 1031 exchanges or IRAs or 401ks. They realize if they can give people incentive to go make the money work for them, and by them, I mean
a business world or new jobs, new creation of revenue streams, it creates more jobs and they actually get more tax revenue. And so the government says, you owe us the money, Beau. And in the scenario of 20 million, let's say you would have paid, I don't know, 8 million of tax or 6 million of tax, right? Instead of paying that, the government says, we'll give you a zero interest loan, Beau, as long as it goes into businesses or real estate that's going to spur economic growth, because we're all going to get, they're going to get more tax dollars and you're going to feel good about it, rather than not selling it, right? And being like, well, I'm not going to sell it. You know, I don't want to pay the tax. That doesn't get the macroeconomics of the money working.
So if I am correct, kind of like on a whole life policy where you can borrow against the policy and you got to pay back like 5% interest. I'm making a loan for X amount, and is it 8% kind of like the standard rate that I'm receiving? The return based on the note rate I'm getting is 8%, assuming that that's where I'm confused still.
Yeah, how are we making the 8%? So, but yeah, the answer, let's break the math down, make it simple. Let's say it's $1 million trust deal. 8% is $80,000, okay? So if you did nothing and we go and put it in the stock market and it makes exactly, about 9.5, 10, and it nets about 8%, and you take that 80,000 in that year, great. You just live off the 80,000, okay? So we got to go earn it. It's not magic money showing up. The money goes in there. We got to go invest it. How are we going to invest it, Beau? So the performance of the note versus what it pays back to you are separate things. And if it doesn't make the performance, then it's going to eat it up the principal, right? Which is not good. So most of our clients set these to be interest only payments. They say, hey, pay 5 to 6% starting in immediately or year 2 or 3. And let's let the 8% compound here, and let's try to go make 8 or 9 or 10% over here on the investments, and just slowly pay the tax. So that's all it is. It's just a loan, but we got to go make the money somewhere. It could be hard money lending, it could be crypto, it could be businesses, it could be real estate.
Okay, that makes more sense. And let's just say you do the deferred sales trust, and you want to buy more real estate. The trust is actually going to be the buyer of that real estate. So you can actually potentially get a loan and lever that up even more to grow your wealth.
Let me give you an actual story. So you're very close there, but essentially yes. So my client sold a $2.6 million business in Alabama. He had no basis, huge tax. Step 1, funds went to the trust. Step 2, he formed an LLC. And then in a joint venture partnership, you can partner with the trust, and the trust funds this LLC. Now, this LLC can go buy real estate, go build real estate, all tax deferred. Okay. So he became the owner again. So he was lender, and then he formed an LLC, and the trust invested with him. And so he's the owner of the LLC in partnership with the trust. And these are these kind of, 2 separate buckets. One is you're an ownership of the LLC. I call it to go fund yourself. Instead of him forming an LLC and having to go get a bank to fund him the money, he had the trust, which owes him the money, fund that deal. Okay. And so that's the cool thing. He can become an owner again. And so these are all the things that we guide people to show them how to do this.
So, wow, this is fascinating. So my dad's a financial planner. And so this would be probably good for him because, it's good for a lot of people, but he has a client that's selling a $10 million building. He wants to invest that money for that client. He could be a referral source to you. And instead of that money getting 1031 into another building, that money could go to him, and he has now $10 million to invest, and he's loving life.
You nailed it, right? And this is why most 1031 exchange companies don't want you to know about this. And most commercial real estate brokers, either they don't want you to know about this or they don't even want to know about it because it takes away the wealth and the commissions from them. And I'm a commercial real estate broker and I've done 1031 exchanges, so I get it. I've also closed Delaware statutory trust. That's why those companies don't want you to know about this, right? It's the best kept secret, and especially for the financial advisor who has the client who's like, I'm done with the toilets, trash, and liability. I got millions of dollars in real estate, but I got my time and energy just being, it's draining. It's draining, never stops. Like my client Chuck in Arizona, we just sold a $2.25 million multifamily property. And he's like, I get calls all the time. I just want to be retired. And he goes, just put it in the top 500 companies in America. Like, I'm done. I'm 70. I want to travel. I don't want to have to take another phone call. I don't have to deal with another 1031 exchange issue or a bank or anything. Like, I'm done. Just send me my monthly payment. Now, a couple of years, he might be like, I want to get back in. These just got foreclosed on, right? Let me buy back. Then he could always form an LLC, and the funds in the stock market that are liquid, he could sell. The trust could sell out of those positions, put into the LLC, all tax deferred. He can go buy that next deal. Like, that's why it's Netflix, right? That's why it's flexible, it's adjustable versus the blockbuster 1031 shotgun wedding, which is a mess.
If you just
at times.
If you just let it accrue and you never take a distribution, I don't know if we call it distributions, but
Yeah, you would.
okay. So, I froze up a little bit. If you didn't take distributions and let it compound, is there any rules that you have to take a distribution at some point, or can you just let it compound?
So the general rule of thumb is to take something out within the first 24 months or so. Something. It doesn't have to be the full 8%. It could be a smaller amount. And that's just over the 25 years of the evolution of this. There's no like required minimum distribution, but it's supposed to, you're going to be taking some kind of distribution. So that's the general rule of thumb. Just keep it simple like that, Beau.
And then essentially this would be when you do take a distribution, and I know you're not a tax preparer or attorney, that would be taxed as capital gain then?
Well, if it was interest that accrued, it'd be interest ordinary income tax. And they'd get a 1099 for that. So let's say it's $1 million and it accrued 8% and you took 8% out, you pay 1099 ordinary income on that 8%. Let's say you took 10% out, but it only accrued 8%. Then on that 2%, you'd pay principal capital gains tax on.
Yeah, I mean, this really makes sense. Like this was, I think I asked a lot of questions, and there's probably a lot more questions that we could go in the weeds with, but I would suggest people watch go to your website or jump on your podcast and listen for more, because I don't want to keep on asking a lot of questions, but I think you answered the majority of my questions on this. This is a beautiful framework, and you don't know what you don't know. And that's just why I do this podcast, because it's just amazing. Like all these advantages out there for people, and they just need to kind of learn like what advantages there are. Like my friend the other day that told me he was selling his company. I can call him right now and just say, hey, you need to at least have a conversation, do your due diligence, get your CPA, get whoever you want on the call. But this could be a viable solution to save you $1.5 million in taxes or whatever else.
Yeah, it's usually 30 to 50%, right? So depending on what state they're in, depending on depreciation recapture, depending on a number of things. And Biden's proposing to raise the cap gains tax federal from 20 to about 25, 26 or 28, which would make it like, let's say 38 to 58. And so it's staggering. Yeah, you could change people's lives on one single concept, right?
Yeah, I mean, it's not really how much you make; it's how much you keep, right? Like that's more important. And this.
It's no longer about cash flow, Beau. It's about tax flow. Okay, and it's increasingly more about tax flow because the government has $30 trillion of debt, and they got to figure out a way to pay for all this stuff, and so they got to increase taxes. So it's not about cash flow anymore, everybody. It's always going to be about cash flow. I get it. It's about tax flow. You've got to, if you're a millionaire, then you're going to exit. You've got to have the best strategies that's going to fit what you're trying to do.
Yeah, and I'm going to send this this copy of this recording to my dad, because he's, like I said, he's a financial planner, and there's been numerous times where he's like, "Oh, I got a client 1031 exchanging." Well, Dad, hey, if you watch this, you're going to get a little tip that you might make a call to Brett.
Can I give a story for your dad real fast? You ready?
Sure. Yeah.
What's your dad's name?
Rick.
All right, Rick, here we go. So this is the other thing we get from financial advisors. By the way, I started out with Covey Securities when I first started out, and I had my Series 22 and 63 licenses, and the financial advisor is the co-founder who created this. But one of the coolest stories with the Deferred Sales Trust that helped me become a believer on this is actually real and legit and all this stuff was one of the top LPL financial advisors used it for his own sale of his own financial advising business practice. And this is about 15 years ago. He gets approached with the Deferred Sales Trust. He's looking at this thing. He's like, oh my gosh, if this thing is real, A, I can retire today. I don't have to wait another 10 years of my business. B, defer millions of tax. C, move out of California and basically live a life, right now, retirement life. But he's skeptical and cautious, okay? And he's smart to be that way because he gets approached with a lot of stuff. Well, he has another thing, ace in his pocket too. His wife is even more skeptical and cautious. In fact, she works for the Secretary of Treasury as one of what's like a G4, G5 attorney. She's like really high up in the government. And in fact, she had been on like with the IRS, you know, battling people over 20 years, people doing stuff they shouldn't be doing. Anyways, he goes, babe, I found this thing. He got a stack of papers. He goes, I'm going to hand this to you. I told you when we got married, I would never do anything that you said you didn't feel good about. And if you don't feel good about this deferred sales trust thing, then I'll go back to work for 5 or 10 more years, however long it takes to net what we need to net for our retirement. He goes, but if this is real, I will sell my practice tomorrow and we'll be done. And she goes, sure, I'm happy to take a look at it. He goes, Brett, a couple days went by. I'm sitting in my home office, and I don't know if you saw that show Suits, Beau. Suits has the guy. It's like, was it Harvey Specter, I think, and then there's like the Michael guy. Anyway, so these big time attorneys in New York, and they're doing all these M&A deals. But every major deal, they walk in with this big sack of paper, and they like slam it on the desk and they make their big point. He goes, well, she came home, Brett, and it was like slow motion out of a movie. It's like that show Suits, and like they have like this stack of papers, and she like puts it on my desk. Now she doesn't slam it down, but she said the 2 words that changed my life. She says, it's legit. And he goes, Brett, that's all you needed to hear. He goes, within the next 90 days, I sold my business. We moved out of California. That was 15 years ago. Anybody who wants to hear that story can hear it. I go, would you come on my podcast and show? He goes, no, I don't like video. He goes, but they can call me and I will talk to them. I'm happy to talk with them. He goes, but here's what I want you to do before they call me. I want you to tell them this. Brett, do you think myself or my wife had 20 years with the government, her reputation, my practice, our financial legacy, me being a financial advisor, would put our future retirement and our legacy on the line for something that we didn't think was 100% legal and 100% legit? He goes, Brett, no way. I went from skeptical to too good to be true to 100% legal. And he goes, it absolutely is amazing. And I'm happy to share that with anybody. And so I always tell people, Beau, I go, Beau, if you're a skeptic and I'm a skeptic and maybe your dad Rick's a skeptic, that's okay to be a skeptic, but be open and minded enough to think that if it worked for, and this guy's name is Cal, okay, if it worked enough for Cal, LPL advisor for 35 years, top in the industry for his own business practice, and his wife, who's the attorney, if it's good enough for them, is it good enough for you, right? And that's the big question you have to ask yourself. And if the answer is yes, it is, okay, that's great. Let's talk with Cal. Awesome. Then we run with it, right? Where we get caught up is they will call the advisor, and that's CPA or whoever the legal person is. Have you heard of this thing? And the person goes, never heard of it. Well, would you do it? No, I've never heard of it. So why would I do it? Right? Or have you had, oh, I've heard of it, but I don't know about it. And they think they know. They don't sign the NDAs. They don't do the research. They don't get with us. And they just say, I wouldn't do it because there's no upside for that CPA to say yes to something they don't know about and something they think that maybe they should know about, but they don't, or something that they have a competing idea. So there's a number of things there, but I would just encourage, Rick, if you're watching this, contact us. We'd love the opportunity to show you the Deferred Sales Trust.
That's awesome. Well, I really appreciate your time. I've learned something new, lots of things new today. Where can people find out more information and learn more from you?
Yes, they can go to capitalgainstaxsolutions.com. They can also search that on YouTube. Capital Gains Tax Solutions. They can look for our new book that's coming out. It's Building a Tax-Deferred Exit Strategy, the proven playbook for unlocking your ideal wealth plan when selling assets of any kind for yourself or your clients. What's really cool about this book is you're going to get like hands-on with how this got started, all overcoming the false beliefs of the Deferred Sales Trust, too good to be true, how to buy real estate with it, all of the above. And we also have a cool guy named Kevin Harrington. You might have heard of him. He's from Shark Tank. He's on one of our chapters. He's not endorsed it yet. You know, he's in his due diligence phase, but we have a whole chapter on us talking about this as it pertains to selling private or public stock and how the Deferred Sales Trust works for that. So, and so much more. So check that out, capitalgainstaxsolutions.com. And then if you're a top financial advisor, CPA, business broker, M&A advisor, luxury realtor, and you're looking to maybe level up your value proposition, you can go to experttaxsecrets.com and you can learn more about what we do there as far as coaching people on the Deferred Sales Trust.
Amazing. This was awesome. Learned a lot. I hope everybody watching enjoy this. Please like and subscribe and share this with colleagues that will get value out of it. And Brett, appreciate your time. This was awesome.
Thanks, Beau.